smile through. Good morning to you.
There we go. Okay, so today, as we usually do, we're going to kick off with a review of the quarterly investment update from the media research team at head office. A couple of tips from Barefoot Investor and the like in terms of smart things to do with your money or be aware of, and then finishing off with downsizing, with becoming more and more common these days as our client base gets older, and I tend to see more and more stuff in the news about it as well. So I thought good chance to talk about some of the pros and cons and the tips and traps, I guess, of downsizing. So we'll start with the quarterly review. This went out, I think, last week on our weekend coffee break email. So hopefully it looks familiar. Again, I'm just going to talk to the key points. First half of the review is the economic side of things, and very briefly, I suppose the takeaway is that the two major economies are the ones we care about, I guess. So look at in the US to start with, as I've highlighted here, growth is slowing in the US, lowest figures since 2022. And the other key economic indicator that's closely watched, of course, is the inflation rate or consumer price index in the US. And again, it's come down a lot from the bad old days of 2 or 3 years ago. But as the commentary says here, around about the 3% range, but it doesn't seem to be trending lower. So the big speculation per the last bit of the highlighted paragraph is when and if or how rate cuts might be coming. The general, I guess, if you read those numbers, there is an expectation by the actual central bank or the Federal Reserve and markets that there should be some cuts coming in the US. Other things being equal, that's generally good for shares. Shares are already on a massive tear in the US anyway, so how much more upside that there is a really good question. And part of the reason I'm talking about this as well is even though the economy is slowing, the takeaway is that the share market is not reflecting that. And again, as I've said on many presentations before and often in our one-on-one meetings, the economy isn't the share market. So one wouldn't want to base their investment decisions on the economic outlook. Probably in the long term, not probably, in the long term, there is a more of a correlation, but certainly at a short-term time frame, there's very little link. In other words, if you see the economy slowing, it doesn't mean you should be selling shares. There's so many different factors that go into those decisions. Looking at Australia, so cash rate still at 4.375. The view here is a bit more mixed in terms of whether or not there's cuts coming. I think the general takeaway would be that it's less likely here or pushed further down the track, which is great for all our clients that have savings and retirees drawing on capital or money in the bank. That rates are going to stay potentially higher for longer because inflation's a challenge more in Australia than the US, for example. But obviously, if you have any kind of debt on your books, like a mortgage, then less good news on that front. Speaking of mortgages, house prices, again, probably the most watched indicator in Australia. National obsession with property, as we all know, and increases continued at a national level. Which is what this point is here, combined capitals. But I think, as is often the case, the devil is in the detail. The devil is in the detail. And just hold on a second, let's double check. I've got everyone in the room. Yeah, great. The devil's in the detail when you look at a headline number versus the individual components or constituents that make up an index, in this case, a property index. And so what's interesting is Sydney grew, according to this report called Logic, by 6.3% annually, but places like Melbourne and Hobart actually dropped. And I think it's a little bit like investing, right? The key is not everything moves in the same direction at the same time, and it's about diversification. Not that you'd be investing in the Australian property market per se, but I think the takeaway is that again, there's so many different factors and different areas that are performing at different speeds, just like in your investment portfolio. And certainly with Victoria, with all the additional taxes they're pushing on to property owners, that's probably no surprise. So, but yeah, for those of our clients in Sydney, other things being equal, your house price should have gone up, or the value should have gone up a little bit. Asset class returns. So I'm going to switch over to our other table, which we use in our reviews with you and our one-on-one reviews. So it should look familiar. Just waiting for the screen to refresh. Here we go. So overall, it continues to be a very strong period for growth assets. In other words, shares, listed property to a degree, emerging markets, etc. Anything in that category, or in terms of what we're looking at on the table here, the five right-hand columns are the growth sectors, if you will, or growth spaces that we can invest in, that we have available as building blocks for your investment strategy. And I've highlighted Aussie shares here, 12.5% return. So again, when you look at these numbers, remember that they also include dividends in the case of shares or listed property. So the 12.5 is a combination of price growth, how much the index went up, in this case, the ASX All Ordinaries to the end of June, plus the dividends that you would have received as well. So roughly dividends are about 4 to 5% a year. So the underlying growth would have been sort of 7 or 8% for Aussie shares. A pretty healthy number, above long-term averages. So that's ticking the box. Been a good year for Aussie shares on that basis. Long-term, when I say long-term, 100-year averages probably sort of around 10%, including dividends. Global shares have been a standout once again. Sound like a broken record, but I'm not judging. I'm just telling you what's what at just under 20%. And the good news is emerging markets as well, where we can, for many of you, we've been trying to roll out some exposure to this sector, and that's been a smart move so far, with the returns from the index pretty much matching Aussie shares as well. So that's great news. That's been so far so good. So thumbs up on that. Happy to address any questions, one-on-one meetings on that space, emerging markets. Of course, we don't trade, invest, live off 1-year returns. We hunt and invest and plan more in sort of the 10 to 20-year horizon for most of us. And that's because on a 1-year basis or 5-year basis or short-term basis, while we've had a great year for shares, as you can see, it doesn't always happen that way. And there's plenty of years when we can be looking at these numbers on a shorter-term basis and they're negative. And in order to earn these returns here, the 10 and 20-year horizon or further, where you can see very high single-digit compounded returns, or in some cases, it's been an exemplary 10 years for global shares, again, mainly driven by the US market, again, mainly driven by the very big tech companies. I won't mention all the names because we all know who they are. That's where we're hunting. That's where we want to be focusing on and targeting returns and aiming for those numbers, such that if we have a year or two where things are weak, we know that if the strategy is put together properly, we can ride out that volatility and earn those returns by staying the course. So this side of the table is where the magic happens, right? It's where the growth comes from. It's where you're earning. It's where you're compounding, and you want to let that compound be uninterrupted as long as possible. Hopefully that's making sense. The left side of the ledger here is what we call the defensive component of your portfolios, cash and bonds, basically. And no surprise to see that cash returns have improved the last 12 months because interest rates have gone up. Sorry, this one here. But historically very low in the last 10 years. Likewise, bonds have been a tough space as well. Only really an issue if you have to be selling them. Otherwise, they still belong in the portfolio. And I'll explain why shortly. Okay, so let's take a look at the path of a typical portfolio. So we just choose, where is it? Where's it gone? That one. We just choose, let's take the 70/30. Again, as I've said before, this is really just a proxy what we're looking at here. So the Vanguard Growth Index Fund is a what's called a diversified fund. It holds exposure to all those different asset classes that we looked at, and basically tries to replicate the returns from each of those indexes or benchmarks. So we use this just as a guide in discussions for the general direction of what your portfolio should look like in terms of values. So I stress it is a general guide. There will be differences between each of your portfolios, etc. The other thing to keep in mind is this is a 70/30 asset mix. So what that means is about 70% of this fund is generally invested in the right-hand side of the table here, right? Property, global shares, etc. And the 30% in the left-hand side. So if you're a more aggressive investor, in other words, you might have 80 or 90% target with shares, or a more conservative investor where you might only have 50%, then the path is obviously going to look different. But this is just a guide to give you a sense of what's been happening in portfolio values. And as you can see from the chart, picture tells 1,000 words. It has been overall a very good 5 years. This is the value of the Vanguard fund the last 5 years, the 70/30. So broadly speaking, that should track, if you're in a similar mix asset allocation, the value of your account. The big caveat here is for those of our clients that are in drawdown phase, in other words, taking money from their accounts, be it super or pension or selling investments, then obviously the path of the value would be different. But the underlying returns from the monies that's in there would still be healthy, as we've seen from those tables we looked at. So hopefully that's making sense. But yeah, as you can see here, the value of the Vanguard fund, or the starting with the 10,000 invested back 5 years ago, is almost at a peak, right? We're almost back to where we were at the end of March. So we had a dip in April and pretty much recovered most of that in the last couple of months, which is great news, in spite of the fact that economic growth is slowing, right, as we saw in the first slide. So again, just goes to show that the economy isn't the share market, and always treat what you hear in the news about the economy with a grain of salt if they're sort of trying to parlay that into investment advice. As I always say, if you any questions, just give me a call or drop an email through. So that's a bit of a recap on performance, and it's been a very, overall, as I said, great year. It's times like this my job is easy, but yeah, the trick is, I guess, we don't have a crystal ball for the future. So as I often say, check your settings, right? And part of our role, of course, when we sit down with you is to check your settings. In other words, how much do you have in each of those asset classes? How does that relate to your personal target that we set up for you? And if there's a big variation, what are we going to do about it? So if we've seen you in the last 3 months, I wouldn't be too worried. If we're going to see you in the next month, again, we'll pick this up as it's a core part of what we do when we review your investment strategy. But outside of that, if you are concerned, just again, drop me an email and we can check the numbers for you. Because at the end of the day, that's where you can add the extra value, is making sure that you're reviewing these settings, and we are as your advisor periodically, and that's called rebalancing if we take action. So that's the key takeaway from the comment, the review. And let me just find the article for Scott Pape tips. Go. So Scott Pape is a great finance writer. He used to be a journalist. He's not a financial planner per se, but a lot of good ideas. He's got, can somebody mute their microphone, please, if that's you? Apologies, it's just interfering a little bit. So Scott Pape does a weekly blog. If you just type in Scott Pape, Barefoot Investor, you can get on his free newsletter. So every now and then he's got some great tips, and the one that I thought was a mistake that I'm making or forgetting about is when you tap or use your Apple Pay or Google Pay, or you're tapping to pay, which obviously is becoming more and more common. As it says here, we're less of a cash-based society now. And so this has become potentially more of an issue or a cost to you as a user. And effectively what happens is when you do tap and pay, the default rails, if you will, or system is it goes through Visa or MasterCard. And in most cases, as you would know, you get charged a surcharge. So the side note to this is if you use a card that accrues points, like frequent flyer points, for example, which we often do, then this isn't applicable because you still want to use the Visa system. Yes, you pay a fee, but hopefully the fee that you pay is less than the benefit you get in terms of accruing the points. So that's sort of as a side note. However, if you're generally just using a debit card, then the trick is here to basically make sure you tell the machine that it is actually, or nominate the FPOS option on the machine. And that way you should be charged less or nothing, because as it says here, the FPOS system is cheaper. So there's the two ways he's suggesting. On your phone, set it up and make sure that you select the FPOS savings in the settings. Again, if anybody needs this article, just email client service and I'll send it through after the chat, or we'll have the video up on the website in about a week or so. So yeah, one option is to do that. The second is use your physical card. And again, I've got in my phone here, got my Opal card, and I've got, in this case, my credit card in the back of my phone, but that could easily be your FPOS debit card, right? So you get it out and use that. And then when you're doing that with your physical card, then you just nominate the check or savings option, and hey presto, you're not being whacked with the surcharge. So that's tip number one. Tip number two, I did a bit of a pivot away from Scott. There's something else I saw that was great, just came out. This is from Money Smart, which is the government's free finance newsletter. Got an amazing website, moneysmart.com.au. Stacks of tips on money management, and this was in their weekly. So this is relevant for our clients that are retired, over age 67, and have some kind of concession card. So either part age pension or Commonwealth Seniors Health Card. And effectively, what it's saying is that you should be eligible for a low fee bank account. So again, there's things like this where you can get lazy, or not even lazy, I guess, just unaware or not clocking what's being slugged by the bank potentially. Hopefully, if you're retired, you've got more time to track this stuff, but you never know. I still think it's a relevant point to be checking. So basically, you should be able to have a low fee basic account with your bank if you hold these cards that are listed here, which is pretty much all our client base that are retired. So go and do your homework, folks, and let me know if you do get a better, if it is successful, or you do get a better deal. And of course, if the bank doesn't offer it, then you may want to think about switching. So another great tip there that I think is maybe not everybody's aware of. Last but not least, let's have a look at downsizing. So as I said, this is becoming more common. I'm seeing more news flow about it, getting questions from clients, and I just thought probably topical and timely to talk about some of the, I guess, in this case, 4 of the mistakes, if you will, that people make. We're only human, right? So I think I read this stuff and I go, yeah, I've seen this with our clients, and it's just part of life. But hopefully we can prompt thought and planning if this is something that's going to be happening in your future. If you're not planning on doing this, you don't have to. If you want to jump off the meeting, that's fine, or we'll have a quick Q&A at the end. So yeah, what are the pitfalls? So I think one is where people get sort of waylaid is on the financial side, that there's property is to the best of my knowledge the most expensive thing to transact in terms of asset, and compared to shares, for example, it's ridiculous. There's pros and cons from an investment standpoint, but everybody has their hand in your pocket when you're selling a property, as it says here, and the government takes a big chunk as well. And maybe I wouldn't feel so bad if they spent it well, but they don't, so it's even more frustrating. So that's the first thing, and so you need to factor that in to your calculations. It may sound obvious, but you'd be surprised what people do and don't forget or remember. And also, I guess it doesn't say it here specifically, but also you need to be conservative, try to be conservative with the sale value. It does state the obvious, but sometimes emotions get the better of people, and they might put it, buy a new place, overpay a bit, sort of on a wing and a prayer that their current home is going to sell for the top end of the valuation, and end up having to dip into their super to make up the difference, or borrow money from kids, or reverse mortgage, or things like that. So it's there's a lot of moving parts, and obviously you can't control the price that you sell, but certainly you can factor these things in, like we do with your financial plan, right? Always a bit of margin for error and safety buffer, so on and so forth. And then think about things like renovations and modifications as well, not necessarily based on your current health situation, but maybe in the future, you might want to be anticipating that. Number two, for those that are on an age pension, what can happen is if you downsize and there's a financial, there's money left over, then that is on the radar for Centrelink, and so that could impact the age pension, and it's quite significant. So if you had 100,000 left over and you're on an age pension, that's a reduction of 7,800 per member of a couple per year. So it's quite a big chunk. And so there's some strategies we can look at when people are in this situation. Again, too much detail for today's chat, but I think the important thing is here, if you are on an age pension and thinking of downsizing, come and get advice, right? And just understand what you're up for, so that the hidden nasties don't come and get you when it's too late. You can, prepare, be financially and emotionally prepared. Sort of somewhat related to the age pension issue is the tax side of things. So not specifically a tax when you downsize, but effectively, if there's money left over and you invest that money, then potentially, depending on what your income is already and your current situation, the income from that money you invest may be taxed. So again, it's important to get advice. That's what I'm here for. There's nothing that frustrates me more when clients go and do stuff without talking to me first. It is a free world, but you pay me to look after you and have your back. So I can't stress enough. Even if it seems trivial, don't hesitate to pick up the phone or drop me an email. I'm more than happy to help on any of this stuff, right? That's what we're here for. So, and the good news is potentially if you downsize, then there might be opportunities to put some of that into super, which is, as you all know, a very tax effective, tax shielded environment. And the government launched a program probably 5 or 6 years ago now, specifically catering for this space, called a downsizer contribution, where effectively, subject to certain requirements, mainly that you live there for 10 years and that you do this within 90 days of selling, each member of a couple can put 300 grand into super. So that's potentially a nice kicker. We've done this for clients who've been fortunate enough to have some money left over, plenty of times. But again, you just got to make sure that we're on your team and we're project managing that for you. Number 4, and this is a little bit related to some of the comments in number 1, that there's today and there's the future, and between here and here, a lot can change, both externally with rules and markets and super, and that's part of our job, is to help you navigate that. but also the health front. And we've seen it lots, right? Again, we're humans, and we're not all robots. We don't just just plug us in on day one and switch us off on year 99 or whatever. It doesn't work like that, unfortunately. So I think the two things out of this comment is that when you move, because it is so expensive to move, and also the emotional burden is big. It's most of my clients and myself, personally as well. I think buying, selling houses and moving is one of the, apart from having kids, perhaps, is one of the most stressful things in life. So if you're going to go through all this, you want to make sure that where you land up is hopefully going to suit you for the long term. And as you get older, things like mobility, vision, health become an issue. So they would hopefully all factor into your checklist, if you will, or your due diligence when you're looking to move or downsize, etc. I've seen people downsize without any financial benefit, just to a newer, lower maintenance place, which makes sense. But again, I think, well, what happens in 5 or 10 years if one of them has a health turn, and that they might have to move to a facility, etc. There's no right or wrong, right? Because everybody has their own values and perception and way of doing things. But these are just things that should be on the radar to think about, what if this and what if that, because you don't know what the future holds. But you do have control and choice over the kind of place you land up in, and where you are and what you're close to, if those things are important to you. Some people have, the kids are a big part of their family. Other people are very independent. Some people want green space out in the middle of nowhere. Other people want to be, in inner city conveniences. Again, it all comes down to personal preference. And very quickly, if it's a financial reason that you're looking at downsizing, so in other words, you might be happy where you are, but you need to raise some cash. There are two options available, and effectively it's just a way of you using some of your money in the house to plug that gap, right? Or it might be a lump sum for renovations, or you might want to help your kids with or grandkids or whatever, a financial gift or a loan. And the common one we see, of course, is gifting or preferably loaning children or grandkids money for a deposit to buy property, because as we all know, particularly the capital cities, it's just getting insane for anyone to get a foot in the property ladder, for the young ones. So, but again, that's one example, but it might be just topping up your fortnightly or monthly living needs, etc. So again, the two options that are available in broad terms is what's called a reverse mortgage. As it says here, effectively, you're just drawing equity out of your home. It's a commercial rate of interest. I think at the moment it's about 8%, and that just it compounds. So obviously that's bad news that there's some debt growing, but it's a heck of a lot easier than selling a house if you don't want to go through all that turmoil that we've talked about potentially. It's a lot easier and less costly initially, of course, because you're not paying all those transaction costs and agents' fees to get money out of your house. So reverse mortgages are one option, and effectively they're paid back when one or two things happen. You eventually do move and there's money left over. Great, pay it off. Or the last of you, if you're in a couple, the last of you passes away. So that's an option. Again, this is just a broad overview. It's not specific advice directed at anyone in particular. A lot of people don't like the idea of having some debt, but if it means you're preserving your super, for example, which might be important to you, then maybe it's not such a bad idea. There's no right or wrong. My role is to help you, if you're in this situation, make an informed decision and weigh out the pros and cons. Another option, which we do see with our clients, probably this, not probably, but in my experience of 15 years of doing this is more common than reverse mortgage. And this is a scheme run by the government, or Centrelink specifically. It used to be called the Pension Loan Scheme. Now it's called the Home Equity Access Scheme. Goodness knows why they changed the name. Probably some marketing guru got paid 50 grand to come up with the new name. It does the same thing. And what that means is effectively you're allowed to borrow money against your house once again. The main difference is it's run through Centrelink as opposed to a commercial bank. The good news about that is the interest rate's about half at the moment, what the banks charge. The other thing is as well, you can't draw large lump sums. So with a reverse mortgage, you could 50 grand, 100 grand, whatever it is, no problems, or drip feed, right? A monthly payment. Whereas this is more structured, I guess. And that's why I like the name pension loan scheme better, because effectively what it does is allows you to draw, even if you're not eligible for the age pension, but you are pension age, it allows you to draw up to 1.5 times the maximum age pension. So roughly that's $1,500 a fortnight for a single. And so I guess the key difference here is run by the government, and you can't draw big lumps, which means in a way you can't get in as much financial trouble. Probably not the right way to say it, but the debt wouldn't accrue as fast or as in such a large amount. And the interest rate's a lot lower as well. Again, when does it get paid back? Same thing, when the last of you passes away, if you're a couple. What I've always seen with my clients, same thing, usually they downsize and they've been fortunate enough that the house has grown in value so much that there's money left over to move to a cheaper place that they like and they're happy with, and covered all those future-proofing issues like mobility, etc. And they go back to Centrelink and pay off the loan. So that's it. A couple of ideas there. As I said, if you didn't want to move, downsize but you did need to raise some money, this is general advice only, as I must stress. So don't hesitate to drop me an email if you have any questions. So that wraps up things for today. So yeah, key takeaways. It's been, in terms of performance, great 12 months. Long may it continue, but we know that anyone who's been around for more than 5 or 10 years, that sooner or later there'll be some fairly big drawdowns. That's just part of life. The main thing is focus on what you can control. If you have any questions about your portfolio, give us a call. Hopefully a couple of good tips there on when using your card to pay, or if you're a retiree, maybe get a better deal on your bank account. And if you're downsizing, 4 of those things to think about, 1, 2, 3, 4, and 2 other options to do if you're trying to raise some money and you don't really want to move, at least not at the moment. Any questions before I wrap up? You can either put them on the chat, and otherwise, yeah, it's going to be an exciting month for Go Australia in the Olympics. I wish it wasn't, the opening ceremony wasn't on at 3 o'clock in the morning, but that's it is what it is. At least when it's in Brisbane, we won't have that problem. But yeah, let's hope we get a good haul of gold medals, and we can earn another gold medal for returns for the next 12 months. So thanks for watching, everybody. Hope that was informative. We welcome any feedback, and if you would like any of the articles, please, the downsizing blog will go on the website as well in next week sometime. But yeah, if you like anything in the meantime, please email the client service team, and that will wrap it up for the day. So have a nice weekend. Thanks for watching.
Thank you, Simon.
Thanks, guys.